Good evening, everyone. Welcome to today's class. Today we'll be looking at IAS 12 income taxes. IAS 12 income taxes. The contents for today's class will cover written accounting for taxation, deferred tax, what we mean by deferred tax. Also look at recognition of deferred tax, the basic approach, recognition and measurement rules, deferred tax, tax for business combinations, and then we'll also consider presentation and disclosure. The aspect of number 5, that's business combination, is specifically for corporate reporting students. So the first section, accounting for taxation. In this section, we will look at taxation of profit. How do we compute tax on profit? Overestimation or underestimation of tax from the previous year. We'll also look at taxation in the statement of financial position. Okay, generally, what do we think tax is? Please, I don't know, I'd like us to have a pin and have writing materials beside us so we could jot some things down. And I also like to be getting responses from the class whenever I ask particular question. And please, when we are solving something and you do not, or even when I'm explaining and you don't get a particular point, please do well to draw my attention. Let me know. Just ask, just say, excuse me, you have a question, and then you can share your question. Because sometimes by the time we reach the end of the class, you may have forgotten or you may have logged out or something like that. Okay, so taxation. Generally, what do we see tax to be? Please, can someone give me a response? What do we think tax is? What's the perception about the word tax or taxation? Please, do I have anybody? Please, can somebody respond? Hello. All right. So taxation, simply has to do with tax. Simply has to do with the part of what a business, an organization, a company contributes to the society. It's a percentage of your profit of what you've earned that is being given back to the society. Is used, taken by the government, is used for public goods such as roads, healthcare, education, and all of that. So companies pay tax. Companies pay tax on their profits. We have different types of taxes. Different taxes for companies, they pay what we call company income tax. For individuals pay what we call personal income tax. Okay, so in the purpose of IAS 12, we'll be looking at more of company income tax because they're the ones that make income which is being taxed. Okay, so in taxation, we have what we call accounting profit and taxable profit. Accounting profit is profit or loss for a period before deducting tax expense. Is a profit or loss for a period before deducting tax expense. Now, this is a FR class and CR class. We have an idea of what statement of profit or loss account looks like. First thing we have is sales. We deduct cost of sales, we now have gross profits. And then after we deduct expenses. And these expenses, what is part of the categories of expenses is we have admin expenses, we have distribution cost, we have finance cost, that's interest cost. We also have taxation. Now, before we deduct taxation, okay, deducting the other expenses from your gross profit gives you accounting profit. You usually have to deduct all the expenses before you arrive at the net profit. So accounting profits is the profit or loss for the period that you've had before deducting tax expense. So what is taxable profit or taxable loss? Taxable profits is a profit for a period that is determined in accordance with the rules established by the taxation authorities upon which income taxes are payable. Upon which income taxes are payable. All right. Taxable profit is different from accounting profit. Now, what brings about this difference is because the way we prepare our financial statements is not the way tax authorities prepare uh compute the tax. Okay, there are some things that we deduct via our financial statements as accountants that is not acceptable under the tax rules and regulations. For example, we deduct depreciation. Depreciation is an expense in accounting, but we uh, but we do not deduct depreciation in tax. Okay, we don't deduct depreciation in tax. What we actually do as regards that is what we call capital allowance, which I'll explain shortly. So deduction is not an allowable deduction. In tax, we have what we call allowable deductions and non-allowable deductions. So we have several other things. For example, in statement of financial statements of profit or loss, we can make room for deductions like donations and all of that. But the tax authorities do not recognize just any donation. They have laid down rules and regulations on what comprises of what are the approved and allowed deductions. So that is what brings about the differences in the profit. So the ones that the tax authorities compute is different from the ones that the company is computing. So current tax is the amount of income tax payable that is recoverable in respect of the taxable profit for a period. Current tax is the amount of income taxes payable in respect of the taxable profit for a period. Current tax simply means tax that you're going to pay in a particular financial year, in a particular financial accounting period. So, how do we compute tax? What and what is comprised in tax computation? We add back inadmissible deductions. That's those deductions that are not approved or not is not allowed by tax authorities. We add them back. Example, depreciation. So all the expenses which are not allowed as deduction as regards taxation profits is being added back. Then we also deduct admissible deductions. There are some deductions that are acceptable by the tax authorities. Now those kind of deductions we deduct them. So we also recognize income recognized in the financial statement, but which is exempted from company income tax. We have some incomes that are in the financial statement that is exempted from company income tax. They also have to note that the tax rate that is applied to taxable profits to calculate how much a company owes in tax for a period. So tax rate is actually the percentage that you will use to multiply against taxable profits to know how much a company owes as tax. This is an illustration. The first one is it's in a tax computation format. We have tax, that's other expenses apart from tax. Then we'll now add back inadmissible deductions. That's deductions that were made, which is not supposed to have been deducted. And we deduct deduction we're not deducted as admissible deductions. And we have taxable profits. Then we take a tax rate, the percentage of taxable profit, and then we have our tax payable, which is the current tax for the period. Okay, we have an example here on taxation computation. Please, I would like someone to read this question for us. Please, somebody should read this question for us. Please, can someone read this question for us?
Hello, can you hear me? Hello?
Hello, can you? Hello.
I can hear you.
Okay. Example, taxation computation.
Example,
Enugu
taxation
traders had an accounting profit of 789,000 for the year ended 31st December 2013. The accounting profit was after depreciation of 70,000 and included a profit on disposal, capital gain of 97,000 naira. The company had incurred borrowing cost of 70,000 naira in the year, of which 10,000 naira had been capitalized in accordance with IAS 23. The company holds some assets under finance leases. During the year, finance charge in respect of the leases was 15,000 naira and renters paid were 80,000 naira. At 1st January 2013, the tax written down value of machinery was 120,000 naira and for buildings was 600,000 naira. Tax regime. All borrowing costs are deductible for tax purposes. Capital gains are not taxable. Fines are not tax deductible. Finance lease rentals are deductible in full for tax purposes. Accounting depreciation is not allowable for tax purposes. Tax depreciation is claimable at 10% per annum for buildings and 15% per annum for machinery applied to tax written down value at the start of the year. Tax is paid at 30%. The tax computation is as follows. Okay.
Okay, thank you very much. This question will be showing us how to compute tax. So tax computation simply means adding what should be added and adding what was not supposed to have been deducted and deducting what was supposed to have been deducted. So in this question, it has been made quite easy for us to know what is deductible and what is not. Some questions may not actually spell out what should be deducted and what should not. So for that, I'm going to send a list of things that are allowable deductions and those that are not allowable. I'm going to send a list of them to the class group so that we'll study it, so that even if we are not told which one is deductible or which one is not, we'll be able to solve the question. All right, so before we start the solution, please can someone tell me what will be the first thing based on our format? What will be the first thing that we will do? What is the first thing we are going to do? Okay, based on our format here, our tax computation format, we have accounting profits before tax. Then we will add back deductions, inadmissible deductions, all the deductions that we made that weren't supposed to be made ideally. And then we'll also deduct deductions that the admissible deductions that are supposed to be deducted. Okay. So in this question, what is our accounting profit for the year? You can see our accounting profit for the year. In this question, what's our accounting profit for the year?
$789,000.
Yes, 700.
Accounting profit for the.
Yes, 789,000. Okay. So we are going to add back inadmissible deductions based on our format here. We'll add back inadmissible deduction. That simply means that deductions are, that are not things that are not supposed to be deducted. We're going to add them. So can you mention one or two things that you think should not have been deducted based on what we've said so far? based on what we have in our question here. What and what should not have been deducted that we need to add back?
According to the question,
Mm.
is it depreciation?
Depreciation, okay.
Need to be had back.
Okay, and what else? One more thing.
And the cap. I'm coming. And profit on disposable capital gain. On disposable, that's assets.
Profit
On disposable, which is 97,000.
97,000. Okay, that 97,000 is the capital gain, and we're
Yes.
told that capital gains are not taxable. Okay. All right, we'll come to that. So you have the first one correct. Accounting depreciation should be added back because it has already been deducted under expenses, so we need to add it back. And then we've also checked part of under tax regime. We're told that fines are not tax deductible. Fines are not tax deductible, and we know that for us to even have accounting profit, fines was already deducted. Okay, so we need to add that one back. And we also told that we also told something about lease finance charge. Lease finance charge, which was 15,000 naira. Lease finance charge simply means we're going to do subsequently in a subsequent class. We'll look at IFRS 16. We'll look at lease as a standard on its own. So I'll not really go deep into what lease is all about, but lease charge simply means what you are paying, for you to make use of an asset. Let's just put it that way. What you are paying, in return for you to make use of an asset for business or for anything. Okay, so we also already deducted that one, which we are going to add back. Okay, before I show us the already solved example, what are those deductions that we made that we should? Okay, what are those deductions that we need to deduct? What are those deductions that need to be made? What are those things we need to deduct via? That is the admissible deductions. Those things that the tax authorities have given us approval to deduct.
The borrowing cost of 70,000 naira.
Okay, borrowing cost of 70,000 naira. The company had incurred borrowing costs of 70,000 naira in a year, of which 10,000 had been capitalized. Okay. What's borrowing cost? What's borrowing cost? What's borrowing cost? Okay, borrowing cost simply, just like the word says, is the standard on its own, is the cost of borrowing, and it can either be capitalized, some of them can be expensed. Okay, so in this case now, admissible deductions, things that we are allowed to deduct, are things that are not subject to tax. Okay, so if you collect a loan, the interest is a liable deduction. The liable deduction, and you're not supposed to receive tax on it, although there are some exemptions which we are going to see subsequently. Okay, so apart from that, apart from the borrowing cost, what else should be deducted? Okay, let's go forward to the solution. Here, from the beginning, we have accounting profit, just like you said, 789,000. And then add back inadmissible deductions. We have depreciation, accounting depreciation 70,000. We have fine paid, which is 125,000. We also have a finance charge of 15,000. Finance charge simply means it's not the rental. Talking about the finance, that's the amount of money that was charged, which is 15,000. And a total of them, we have 210,000 naira. Then the admissible deductions, things that we are allowed to deduct that tax should not be calculated on. We have the lease payments 80,000 naira. We have capital gain because our question here told us that.
Excuse me, please, before you go further.
Okay,
The fine paid, check 125,000.
I should define.
Said the
I
fine paid 125,000. Please, the figure. Where do you get the figure, please? Is it on the question?
Okay.
Can you hear me, please?
Can you hear me? Think I'm. Hello.
Yes, we can
yes, we
hear
can hear
you.
you now. We can hear
Okay.
you now.
So please, what was the question?
I said the fine paid 125,000. Where do you get the figure?
125,000. That's
Yes,
for
fine paid.
fine paid.
Yes.
Okay. Okay. Let's go back to the question. Checking my equation here. Mm. Now, oh, okay. 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 There's a mix up in the question. Okay, please, I'll send the corrected version of. I've checked the notes now. I've seen the mix up in this question. So I'm going to send the corrected one to the group later. We on Monday. I just noticed it now. It wasn't included. Cut out. Okay. Okay, apart from that one, can we proceed? Hello.
Yes, let's proceed.
Okay. All right. Okay. So I think there's even another error again I've noticed as well. Oh, okay. Let's proceed. Uh, we also have lease payments that will less. These are the admissible deductions are things that are not supposed to be charged. Anything that you're adding back, like those things that we've added, add back these deductions simply means those things are supposed to be charged. At the end of the day, what we have as our profit is what we are going to use the tax rate on. So anything that we don't deduct means that that thing is subject to tax, and anything that we deduct, it simply means that it has been exempted from being taxed. That's what it means. Okay, so we also have okay, under admissible deductions. Okay, we have lease payments. Lease payments here is not subject to tax because lease payment. What lease payment simply means is that in either finance or operating lease, it simply means the amount of money you are paying. Like I said, the definition we're going to use for this class to use a particular asset. So since you're actually paying, just like paying rent, okay, it is an allowable deduction. Rent is allowable because we tax is computed on profits, and profits is when you deduct your expenses, okay, from the profit. So from your sales, your income. So what you left is the profit that tax is being charged on. The reason why tax authorities have come up with their own schedule of what should be deducted and what should not be deducted, simply because sometimes because we want to report a less profit, because a lesser profit means that we will pay lower tax. So we can just come up with, oh, we made a donation to a particular charity organization, maybe a motherless babies home. How much? 50 million. Where is the uh, charitable organization? Of course, it can be, you can form one immediately, or you can even liaise with one and say, okay, let's just tell them that we actually, gave a sum of 50 million naira for the orphans and all of that, So tax authorities are trying to, they're trying to block loopholes in tax regulation. Okay, so like I said, I'll send the schedule. There are some donations, specific donations that should be made. We are making a donation to a religious body. We have two specific religious bodies you should donate money to. You understand? So anything that is an allowable deduction, it simply means that it should not suffer tax. So lease payments is not supposed to be taxed. So that's why it's being deducted. Then capital gain. This one is capital gain is an aspect of taxation, capital gain tax. CITA, for those of us that are doing taxation, advanced tax, will understand what capital gain is. So it is being deducted here. It is not suffering taxation because it is already being taxed under capital gain tax, that's CGT. Then borrowing cost capitalized. Borrowing cost capitalized is not taxable. Why? Like I said, borrowing cost is, this one here has been capitalized. This one here, it simply means that it has been added to the cost of the asset or whatever it is. When something has been capitalized, it simply means that that particular figure, that particular expense has been included into the cost of the asset. So if it has been expense, it means it's an expense. So it is not taxable. That is why we are deducting it from the accounting profit. Okay, then we have what we call accessible profit. Then accessible profit is accounting profit plus the inadmissible deduction that has been added back minus the deductions that have been made. We now have 812,000 as our accessible profit. Then the next thing is for us to less capital allowance. Capital allowance. Please, can someone tell me what depreciation is? Depreciation before we go forward. What is depreciation? What is depreciation, please? Depreciation.
Hello? Oh,
Yes,
yeah.
I can hear you. Yes, I can hear you.
The wear and tear of a tangible asset.
We and tear. Okay.
That
Apart from that, okay. Depreciation is an accounting estimate. Our next standard will be on is on IS 8, accounting policies, estimates, and all of that. Depreciation simply means is spreading, okay, like you said, wear and tear, but it also has to do with spreading the cost of the assets over a particular number of years. Your asset is said to is going to survive for 10 years and we bought it for 100,000. Okay. If you use the straight line method, and get it at 10,000 every month as our depreciation. Simply means that when an asset is being used, the value reduces. Okay, so there's no point. Maybe you bought the asset for 100,000 and then you've used it for 1 year. You can't sell it again for 100,000. All things being equal. So now the depreciation is an estimate in accounting. It does not it's not an expenses that actually exist. Okay, we can just come up this year and say that okay, our depreciation rate is 30%. All of this is in an effort to reduce profits. When you increase your depreciation percentage, the rate, it will increase the depreciable amount and the depreciation figure. And when it is increased, to reduce your profit. So the tax authorities are like, no, we will not accept that accounting term that does not even exist in real life. We will make use of what we call capital allowance. Now, capital allowance is a replacement because it's similar to depreciation. It's just like, should I say, it's a relief, okay, that is given to the organization for a particular asset. Okay, so capital allowance, you can tell you have what we call initial allowance and annual allowance. So for the first year, for plants, for example, we have 50% allowance. And then subsequently, you can have 25% and 20%. Okay, so that's the same thing here that happens. So in this case now, remember that depreciation had been added back, accounting term. So we now less capital allowance. And in our question, we were told that the tax written down value of machinery was 120,000 and buildings was 160. And we're told that tax depreciation is claimable at 10% per annum for buildings and 50% per annum for machinery. So 10% times 120, 10% times 600,000. So that gives us 78,000 naira. Deduct. Now, getting it down gives us a taxable profit of 734,000 naira. So taxable profit is assessable profit minus capital allowance. Okay. So our taxable profit, that's the profit that is subject to tax, is 734,000 naira. So income tax is 30%. Like in this question, we're told that tax is paid at 30%. And we've also seen that education tax is 2% of assessable profit, something we call in tax. We have different types of taxes, but every company is expected to pay income tax and education tax. So income tax, please take notes, is 30% of taxable profit, while education tax is 2% of assessable profit. That is 812,000. Education tax is being deducted based on the profit you have before deducting capital allowances. So the total tax that you will pay to FIRS is 236,440. Please, you can note it down. The education tax is 2% of assessable profit. Okay. So we move on to tax base. what is tax base? What is tax base? So tax base is simply when you say tax base, the tax base of an asset is the amount that is attributable to that asset for tax purposes. It's the amount that is attributable to that asset for tax purposes. That's just a simple definition. So the tax authority's view of the carrying amount of the assets measured as cost less capital allowances. You know that carrying amount of an asset in accounting, carrying amount is cost less depreciation. Okay, but tax in taxation, we call it tax base. We call it tax base, and it is a cost less capital allowances. So it is the tax base of an asset that is the amount that the tax authorities will allow as a deduction in the future. So how do we measure current tax liabilities for the current period? Current tax, you have current tax liabilities, you also have current tax assets. So tax is a liability, of course, and tax can also be an asset. How can tax be an asset? When you have, for example, I remember when I went to the Board of Internal Revenue for my organization to pay taxes. So when I went, I submitted my schedule and they prepared their own schedule for me. And the tax I was given to pay was more than what I completed. And I was like, I don't understand. So I now had to recompute mine and take it to the tax authorities. So that is why in as much as the tax authorities will also compute their own taxes, you also have to compute your taxes as well as an organization. So now what they had given me was more than what I had in my own statement. Okay, so upon going there, we did a tax reconciliation. I prepared my own schedule and then compared with that. So they now saw that they did not deduct pension because ours was personal income tax, not the one I'm talking about was personal income tax. That is for the staffs and not for the company. So that was that they did not deduct pension. So that was what caused the discrepancy. Now, assuming that, for example, the tax authorities, what they computed, our tax was 50,000. Let's say our company income tax was 50,000. And then when I now, after paying 50,000, and then upon reconciliation, I discovered that, I was not supposed to pay 50,000 as tax. I was supposed to pay, let me say, 46,000. Okay, so that's 4,000 now. That is the difference. Okay, that means I have overpaid. Okay, I've overpaid, and of course, you know that the money will not be refunded back to me. Okay, so it will now be used to offset the subsequent period. So current tax liabilities for the current period, current and prior periods must be measured at the amount expected to be paid to the taxation authorities using the tax rates and tax laws that have been enacted or substantively enacted by the end of the reporting period. So we make use of the tax rate that we're going to pay and that we are expected to pay to the taxation authorities. So, okay. This is a part of what I was just talking about, overestimate or underestimate of tax from the previous year. Now, we know that if you look at a statement of financial position, it is usually prepared most times, oftentimes at the end of the period, which is one accounting year. And you know that tax is charged on accounting profit. Okay, and if this statement is being prepared at the end of the year, okay, at the end of the year, So how then do they get figure for current tax? Right? This statement of financial position is prepared at the end of the year. That's after the 1 year period. Okay, and then before you can now say, okay, this is our profit that then we will now pay tax on. So how then does the company know that, oh, this is actually the amount of tax we are going to pay? So they make use of estimates. You know that the tax authorities themselves will also prepare their own taxable profit. So they make use of an estimate. So current tax for current and prior periods must be recognized as a liability until it is paid. So the current tax that we have is 50,000, is a liability until we pay. So if the amount already paid exceeds the amount due, then the excess must be recognized as an asset. That's what I said. If what we've paid, for example, we're supposed to pay 46,000 and we paid 50,000 as tax, that simply means that we have a tax asset of 4,000 naira, which will be used for the next period. In these circumstances, the tax charge for the year is adjusted for any underestimate or overestimate in the period. So an underestimate of tax in the previous year's profit is added to the tax charge for the current year, and an overestimate of tax on the previous year period is deducted from the tax charge for the current year. So if we underpaid this year, it means that we are still owing, which is what's going to be added to our next period. Okay, let's see. This is just an illustration on overestimate or underestimate of tax. There is no question. We're just showing this like a kind of format to show us how what it has to do with overestimate, or if you have an underestimate of tax. Now we have profit from operations, which is 460,000. Then we have interest. Then we have profit before tax. So accounting profit simply is a profit before tax, which is 400,000. Then we now, next thing after having profit before tax, we're supposed to deduct our tax, but we have adjustments because of underestimates of tax in the previous year. So we had an underestimate of tax. That means in the previous year, the tax we paid was less by 3,000. Okay, let's say our tax for the previous year was 90,000 and we paid 87,000. So that means we are still owing the tax authority 3,000 naira. Just like when you are paying NEPA bill. A NEPA bill, you're given a bill of 22,000 and you paid 15,000. Okay, you still have some money left that you are still owing. Okay, so which will now be carried forward to the next period. So here in this case, we had 3,000 that was left from the previous year, and the current year tax is 100,000 naira. Okay, so adding this to both of them, we have 103,000, which is the tax charge for the year. So we deduct 103,000 from profit before tax of 400,000, and we have a profit after tax of 297,000 naira. Okay. So how do we treat tax in the statements of financial position? Mind you, tax is going to appear in your statements of financial position and also in the statements of profit or loss. So in the statements of financial position, how do we go about having that tax figure there? So like I said, taxation charge is a liability that the company is expected to pay. Okay, so timing of tax payments on profit can vary from one country to another. It depends on the tax rules in each country. So generally, this is the format for taxation in the statement of financial position. So now, first of all, we have tax payable at the beginning of the year. That means what you were owing us, from last year, the tax that you've not paid, the remaining balance from last year that you've not paid will be brought forward. Then the tax charge for the year, that's the tax that has been charged on that particular profits for that year. Then if you've made payments, okay, let's say the tax that was brought forward is 2,000 naira, and then the tax charge for the year is 10,000. So that means you're owing tax of 12,000 naira. And then during the year, you made payments of 8,000 naira. So 8,000 naira deducted from 12,000 naira, that means you are owing. That's tax payable. Payable simply means what you are owing. Okay. So tax payable is 4,000 naira. So in the next period, it will be brought forward. So tax payable for the next period will now be brought forward as 8,000 naira. So the tax credits in your statement of financial position under liability, okay, you have 8,000 naira there as your tax liability. Okay, we have an example here. I'll give us some seconds to read through the question and then we'll proceed. Okay, please, can someone read the question for us? Please, someone should read the question for us.
Example.
Please, we're still waiting. Please, someone should read the question for us.
Can I read?
Yes, you can.
Taxation in the financial statement. Fresh company has a financial year ending on 31st December. At 31st December 2012, it had a liability for company income tax of 77,000. The tax on profit for the year to 31st December 2013 was 114,000. The tax charge for the year to 31st December 2012 was overestimated by 6,000. During the year to 31st December 2013, the company made payment of 123,000 in income tax. I'm done.
Okay. So what was the tax expense that was carried forward from last year? From our question, how much were we owing before the current year?
77,000.
So 7,000, okay. And how much are we billed for this year?
Tax
Around 40,000.
is 114,000.
Okay. Did we overpay any? Do we have any overestimates of any amount?
Yeah, 6,000.
6,000. So how much will be our charge for this year? What do you think will be our charge for this year?
62,000.
114 minus 6,000.
Which will give us 10.
Yes.
108. Yes, we are
Yeah.
correct. Okay, so now tax on current year profits is 114,000. And then we had an overestimation in the previous year, so it's 6,000. Then we deduct this, we have 108,000. So our tax liability in the statement of financial, that simply means how much we are still owing as per tax will be based on the formats we did. We tax at the beginning, payable at the beginning of the year. That's tax brought forward from last year. Then we will now add the tax charge for the year. Okay, which in this case is 108,000 naira. Okay, so adding both of them, we have 185,000. Then tax payments that have been made during the year. So during the year, we paid 123,000. That payment, deducting it from the charge, we now have a payable of 62,000. That means that in the next period, we are still owing tax authorities 62,000 naira. So we are going to pay the tax authorities. We still have a liability. That's what we are owing them of 62,000 naira. Okay. We are on to the second section, deferred tax. What is deferred tax? To look at deferred tax, the underlying problem, we'll look at identifying deferred tax balances, and then we'll consider IAS 12 approach to the problem. So before we proceed, when you hear the word defer, what comes into your mind? Defer. That's defer.
I think the Fed postponed.
Postpone, yes, postpone. I remember when I started school, I heard some people who said, I had a friend, she said, she wants to defer her admission, that she doesn't have money to start this year. So she's looking at next year. So defer means something you're supposed to do today. You're like, oh, I'll do it, some other time. Okay. So we already talked about, we really looked at deferment. So now let's look at what causes this deferring tax. Tax has to do with measurement of certain assets, liabilities, income, and expenses, from tax purposes. Now, the tax rules is different from the IFRS rules. That's International Financial Reporting Standards. Our standards are different from tax rules. So this can result in different figures in the financial statements and in the tax computation because they are following their own rules. We are following our own laid down accounting rules. So it is convenient for us to envisage two separate sets of accounts, one that is constructed following IFRS rules and one that is constructed following tax rules. Now, companies also have tax consultants. Like I said, the tax authorities will prepare their own tax schedule, computation, and then they'll bring it to you. But you should also be able to prepare your own. Prepare your own financial statements with your accounting procedures, and also have one that is prepared. You following the tax rules, so you don't end up, being cheated and all. So it simply means that we also have to prepare yours, because knowing that tax charge is not the tax rate that is applied to profit before tax. We have profit before tax. It's natural for you to just compute maybe 30% as the charge over over the profit before tax. After all, tax rate is 30%. Okay, but it's usually not the same because the tax authorities are not going to have, they're not going to have the same profit before tax with the tax authorities because of those deductions and non-deductions. Okay, so we have an example here. Just give us some seconds to just go through it before I start the explanation. Okay, please can someone read the question for us?
X Limited made accounting profit of the years 20X1, 20X2, and 20X3 and paid tax at 30%. X Limited bought an item of plant on 1st January 20X1 for 9,000 naira. This asset is to be depreciated on a straight line basis over 3 years. Accounting depreciation is not allowed as a taxable deduction in the jurisdiction in which the company operates. Instead, tax allowable depreciation is available as shown in the following tax computation.
Okay, all right. So we have accounting profits before tax of 50,000 naira. So accounting profit, remember, it means that the profit, they already deducted depreciation. All right, so we have accounting profit for the 3 years, 50,000, 50,000, 50,000 for 2001, 2002, and 2003. So like the rule says, we add back in deductions, in admissible deductions. So we add back depreciation, which is 3,000. Okay, how did we get depreciation? The item of plant was bought for 9,000 naira, and it is to be depreciated on a straight line basis over 3 years. So formula for depreciation following the straight line method simply is cost minus residual value all over a number of years. So in this question, we don't have any figure for residual value. We only have cost and number of years. So it will be 9,000 divided by 3 years, which is 3,000 naira. Okay, so we add it back and then we deduct capital allowances. Remember what I had said, that depreciation is not allowed, but capital allowances is allowed. Now you might ask me, what is the figure? How did we get the figure for capital allowances? It is usually, it will be given in your question. If it is not given, you'll be given a percentage. Since this is not a core tax cost, you'll be given a percentage for capital allowance. It could be, they will tell you, they can tell you 50% as initial allowance. That means that in the first year, you deduct 50%, and then subsequent years you deduct 25%, or you can be told the exact figures to deduct. Okay, so that is how it is. But at the end of the day, you end up having the same amount of 9,000 of the cost of the asset. Okay. So we deduct capital allowance because that's what is allowed. So if you notice in year one, the capital allowance is 4,500 and it is more than the depreciation. Okay, so we still have, that means you're deducting much more than what they added back. So we deduct that, add and deduct, we have taxable profit of 48,500 for 2001, 50,500 for 2002, and 51,000 for 2003. So we can then have 30%, calculate 30% tax rate on intangible profit, which gives us 14,500, 5,500, sorry, 14,550 naira, 15,150 naira, and 15,300 naira for 2003. Okay, so if we do not have deferred tax, this is how this is going to be recorded in a statement of comprehensive income. That is if everything, what I mean by deferred tax is if everything was being paid off in each of the period, okay, nothing was kept to be paid later. We'll just have 14,515 naira for first year, 15,150 naira for second year, and 15,300 for the third year. If you add the three of them together, you will discover that you have 45,000 naira. Remember that the profit before tax is 50 plus 50 plus 50, which gives us 150,000. So 30% of 150,000 it still gives us 45,000. That's in total, which is what we have as our total income taxes for this year. Now, this is achievable because we have the same figure as our profit before tax. Okay, there was no increase or any significant decrease like that. Okay, and in this case, this item of plants was written off in 3 years. We did not have subsequent, it did not exceed this number of years that we're given here. Number of that's 2001, 2002, and 2003. Okay, so we're going to see more where we go into temporary differences. That's where we'll see more of the deferred tax. Okay, so identifying deferred tax balances. Like I said, tax is relevant in statements of profit or loss. It's also important in the statements of comprehensive income, that's income and tax expenses perspective. So how do we view these differences? So the differences is when we compare the income and expenditure recognized under IFRS, we also compare it to the equivalent figures of what we have based on the tax computation by the tax legislation. Okay, so if you have any differences, we'll now have, that's if you have a deferred tax expense or credit that is being recognized in the statement of comprehensive income. So for the statements of financial position, that is asset and liabilities perspective, the differences that are identified on a cumulative basis by comparing the carrying amount of assets and liabilities under IFRS to the carrying amount of the same assets and liabilities according to the tax rule. So IAS 12 uses statements of financial position perspective. Well, we're going to talk about both of them here for greater understanding so that you know what happens to income statements and also what happens in the statement of financial position. Okay, please take some seconds and go through this example before I start talking about it. Okay. Please, can someone read this for us?
Following table identifies differences. Hello? The following identifies the differences between the accounting.
Okay. To the following table, from what we have seen here, here we're going to look at the differences that has to do with the different kinds of treatment of plants from both perspectives. So on 1st January 2001, the carrying amount of the assets is 9,000, and of course the tax base is also 9,000. So the charge for the year is 3,000. This is from the example we did previously, this one. We can see that our depreciation here was 3,000, and we have capital allowances. Okay. So the charge for the year under carrying amount, that's the one with the company, is 3,000 naira. And the tax base, as the tax authorities, the capital allowance is 4,500 naira. So the difference is 1,500 in income and expenses. That is the charge. Okay. Capital allowance is 4,500. And the difference is 1,500. So it's in brackets. I'm going to explain why it's in brackets shortly. So the difference between both of them, cost as at 31st December 2012 is 6,045, and the difference between the both of them is 1,500. So for the year, that's 2002, 1st January, we still have the depreciation charge of 3,000. Since it's on a straight line method, the depreciation is still 3,000. And then the capital allowance for this year, this period, is 2,500. So deducting both of them, we have 500 naira difference, which is in income and expenses. This one is not in bracket. I will explain that shortly. And then what we have left is 3,000 for carrying amount and 2,000 for tax base. So the subsequent year for charge is 3,000 naira, and then 2,000 naira for tax base. And then we finished everything for it. So we have a difference of 1,000 naira. Now, in 2001, 3,000 naira, which is the depreciation figure, was not allowed, because it's not an allowable deduction, but 4,500 naira was allowed instead. So we have a difference of 1,500. Is this a gain to the company or a gain to the tax authorities? Please, can someone answer? What do you think? Is this difference a gain to the company or a gain to the tax authorities? You know that if it's a gain to the company, it means it's a loss to the tax authorities and vice versa. So is it a gain to the company or a gain to the tax authorities?
It's a gain to the company.
To the company.
Yes.
Okay. Why? What makes you say so?
Because they have a higher deduction in capital allowance. They were given
Okay.
allowances of more than what they had already deducted as a position.
Okay. Okay, so this simply means that percent of 1,500. 30%. I believe we have calculators with us. 30% of 1,500.
This was 1,350.
30% of 1,500 is 30% of 1,500.
No,
Yes.
I calculated 30% of 4,500.
30% of 1,500. That's the difference.
$450.
Okay, good. 450. So now the current tax will be reduced by 450. If current tax is reduced by 450, is it a gain to the company or to the tax authority?
Again to the company.
Yes, because they are going to pay a lower tax.
Yeah, they are going to pay. Yes. Again to the company.
Yes. Okay.
It's lesser than what they found.
Yes. Okay. So for the second one, for a
Ma, I did not get your explanation on this 450. Please.
okay,
The
and the
sound
difference
is-
is, can you hear me now?
Yes, I can hear you now.
Okay. So we had depreciation 3,000, carrying amount, capital allowance for 2,500, and the difference is 500. So is this a gain or a loss to the company?
As against it's a loss to the company.
Okay, why?
The reason is that the company is going to pay, they have already deducted 3,000.
ID.
Okay, so yes, sir.
Yeah, so Mr. Wasil, repeat your answer again.
Okay, I say it's against the company because
Is again.
yes, now
Okay,
the
why?
capital allowance is lesser than the depreciation. You know, when they did the reconciliation, so they need to pay lesser. Instead of paying 3,000, they are now paying 2,500.
Okay. All right. Someone else? Any other opinion? Okay. All right. Remember that this capital allowance is not being paid. It is a deduction. It is a deduction, okay? And as a deduction, it's actually reducing what you are paying. It reduces your profits. So if your deduction is lower, it means that your profit, your taxable profit, is higher and you pay higher tax. But if your deduction is lower,
Understand now?
you understand? In this case now,
Yes, I understand it now.
it's not a benefit to the
tells
company.
us what you are reporting. Okay,
Yes.
without this naira denomination, we never can tell what
Please continue.
Okay. All right. So for the next year, we have a capital allowance of 2,000 and depreciation of 3,000 naira. And the difference is 1,000 naira. So what do you think will be done in this case? What do you think? Is this a gain or a loss to the company? Is it a
Based
gain or
on
a
the
loss?
normal, yeah, it's a loss now because
Is it
the company they will still charge. Is it they are the profit there's going to it's still going to be high. You understand? So there's going to be a higher charges on the
so that
profit
means
again
that
because
that
of
means
the
that
fall of the capital allowance.
yes, that means that they will compute extra tax. That's 30% of this 1,000 naira. So I mean their tax will increase by 30% of 1,000 naira, which is 300 naira, right? 30% of 1,000 naira is 300 naira. So their tax will increase by 300 naira. Okay. Do you understand? Do you get the concept?
Yes, yes.
So when a tax base is lower than the carrying amount, okay, the company will pay the additional tax.
Higher.
Yes, but when the tax base is higher than the carrying amount figure, okay, that means that the company's tax will be reduced by 30% of that differences. Okay, so let's see how the statement of comprehensive income will look like. Okay. Okay, so all of this is still from the very first example we had. Okay, so our profit before tax is 50,000. That's for the 3 years, and remember how we did we got this income at 30%. Okay. Then the deferred tax for year one is 450. Remember, this one was an income. Simply means that the current tax, that's the tax, will be reduced by 450. And then subsequent years, the tax, they will have to, in 2002, based on what we did here, the difference of 500 naira, they have to pay extra 30% extra tax, which is 30% of 500 naira for the second year, which is 150 naira, and then pay extra tax on 1,000 naira, which is 300 naira. So on that note, we now see that 2001, this 450 is not in bracket because it is an asset. Remember, it is an asset, so it is a deferred tax asset, not a deferred tax liability. So for 2002, it is 150. That means they are owing 150 naira. Same thing for 2003. Okay, so deducting everything, we have our profit after tax of 35,000, 35,000, and 35,000. So in our statements of financial position, deferred tax liability in 2001, balance brought forward is nil. For 2002, balance brought forward is 450. Then we deduct for that year 150. Same thing for 2003, and then we have nil. So what this simply means is that in 2001, they had a tax asset of 450. Okay. And then 2002, they had a tax liability of 150. So they will now deduct it from the already existing asset of 450. We now have 300. Then the remaining 300 from the last year is deducted from the existing 300, which now gives us a nil balance. That gives us a nil balance for the end of 2003. Okay. So this is a presentation of, let me say, the statements of financial position in the perspective of the taxman. So please take some seconds and study this presentation, and then that's the explanation. Okay. This is just financial statements presentation of what we've done. Okay. We'll go to section 3. Of today's class, which is recognition of deferred tax. That's the basic approach. Here we'll look at identifying temporary difference, taxable and deductible temporary difference, accounting for deferred tax and sources of temporary difference. Basically, we've actually talked about temporary difference already. Our ability to recognize the difference between the carrying amount and the tax base as already, is already temporary difference. So we have in taxation, we have two types of differences in that's what makes it what we have from the accountants different from what we have from the tax master. Okay, so we have two types of differences. We have the temporary difference and we have the permanent differences. Just like the word says, temporary difference simply means differences that can be settled in the future, of course, while permanent differences is that it's there, it's irreversible. So for the context of this standard, we will talk more about temporary difference. So temporary differences are differences between the carrying amount of an asset or liability in the statement of financial position and its tax base, which is what we have just done now. So we have temporary differences may be either one, taxable temporary differences, which are temporary differences that will result in taxable amounts in determining taxable profit or tax loss of future periods when the carrying amount of the asset or liability is recovered or settled. We also have deductible temporary differences, which are temporary differences that will result in amounts that are deductible in determining taxable profit or tax loss of future periods when the carrying amount of the asset or liability is recovered or settled. Okay, we'll look at an example. So from what we have here, you can answer that temporary differences can either be taxable temporary difference or deductible temporary difference. So simply means that the differences could either be taxed or it could be differences that will bring about a deduction in the tax computation. Okay. So what is deferred tax? Deferred tax liabilities. These are amounts of income tax payable in future periods in respect of taxable temporary difference. Like we said, deferred means to postpone. Okay, so the amount of income taxes that you're not paying now, but you're paying in the future. And these differences came as a result of taxable temporary differences. So a deductible temporary difference is caused by a credit in the carrying amount of an asset or liability in the financial statement compared to the tax base of that item. So deductible temporary differences lead to the recognition of deferred tax assets. So like I said earlier in the class, that we could have a tax asset, deferred tax asset, and also deferred tax liability. So deferred tax asset is when, what you've paid is more than what you were supposed to pay. So that means they're actually owing you. So that is a deductible temporary difference. So in the next period, they will just deduct that amount of money that you've overpaid, that overestimate, the overcharge from the current charge so that you pay lower. So that's deductible temporary difference. While taxable temporary difference is the one that, of course, from the differences is that you have to pay high and something else extra. Okay, so that means that you're owing us, okay, you paid supposed to pay 1,000 naira, but you paid 800. So next period you're owing 200 naira. I will compute tax on that 200 naira. That's happens to be a deferred tax, and that one is the liability because you are still owing the tax organization. So deferred tax are the amount of income tax recoverable in future periods in respect of deductible temporary differences, carrying forward of unused tax losses, and the carrying forward of unused tax credits. Tax organizations, when a company is running at a loss, they can actually waive taxation for a particular period. Okay, so it's also a tax. It's more or less like an asset to the organization. So we also have carry forward of unused tax credits. It's possible that the organization did not make use of the previous tax credits. That is the previous overestimation. They just keep carrying it forward. Okay, let's look at this example. Let's study it for a while and then we'll proceed. Okay, each of the following is a deductible temporary difference that will lead to the recognition of a deferred tax asset. Number one, non-current assets. Here, you can see that the carrying amount is less than the tax base. Tax base is 1,200, carrying amount is 1,000. So the temporary difference is 200. And the deferred tax as 30% of 200 gives us 60. So that simply means that this is an asset in the next period. They're going to deduct the next period tax will be less, will be reduced by 60. So for receivable, the tax base is 90 and the carrying amount is 80. So the same thing happens because tax base is still higher than this other one. So we have 100 and the tax is 30%, which is 30. Then we have payable. Payable is 1,200. Tax base is 1,000. Temporary difference is 200, and then the tax is 30%, which is 60. And now, please, can someone tell me why payable? Because I said that when carrying amount is lower than tax base, the tax on that difference is a deferred tax asset. So why then is payable here also classified as a deferred tax asset, even when carrying amount is higher than tax base? Please, you can attempt that.
Hello, sorry, please. The question is not clear. Please come again, please.
Okay, I said I have said that when the carrying amount is higher than a tax base, it will result in a deferred tax liability from what we've done so far. When the carrying amount is higher than tax base, it's usually like that. And when the tax base is higher than the carrying amount, it results in a deferred tax asset. So why is payable here? We see that payable has a carrying amount of 1,2 and a tax base of 1,000. The difference, of course, is 200, and 30% of it is 60, and it is still regarded as a deferred tax asset. Why is it so? What is the rationale behind it? What do you think will be the reason why? What does payable mean? What's the meaning of payable? What's the meaning of receivable?
Payable means what you are owing, what you're going to pay.
Mm-hmm.
And receivable is what somebody is owing you, you are supposed to receive in the future from a
Okay.
person.
Okay. So if a customer is actually going to pay you money, remember it's an income, and your income is subject to tax, right? Right?
Okay.
Income is subject to tax.
Yes.
Okay. So payable is something you are owing somebody outside. It's an expenses. Okay.
Yes.
And expenses that are directly attributable to the business are supposed to be deducted and not taxed. Right? It's supposed to be deducted so that you can have your profit, which is now subject to tax. So that is why payable here is not a deferred tax liability, because you are the one that's actually paying money out of it. Okay, the one that is paying out of it. Now the tax people had placed your payable at 1,000 naira. Meanwhile, it is 1,200. Okay, so it means that your tax should be reduced by 60 naira or 60,000, depending, 60 naira, because they had understated your payables to 1,000 naira. Remember that payables is a liability. You are deducting payables in your income statement for you to now have profits. And payables, people that you are owing, and of course in business, it is directly attributable to that business. So it is an allowable deduction. So since they had understated your payables to 1,000 naira based on their tax base, and actually 1,200, so that difference, it means that when they were deducting, for example, let's say your income was 2,000 naira, okay, and payables happens to be the only expenses. So 2,000 minus 1,000 gives us how much?
1,000.
1,000. And 30% of 1,000 gives us 300, right?
Yes.
Okay, so our tax is 300 naira. Okay. Meanwhile, from your books, your payables is 1,200. So if we down to 2,000, which is your income, 2,000 minus 1,200, what will be our accessible profits? Sorry, our taxable profit, yes. 2,000 minus 1,200.
It's 1,002.
2,000 minus 1,002 give us how much?
1,000.
2,800,
800.
yes. And so computing 30% on that 800 will give us how much?
240.
240. So you see now that they made us pay based on their calculation. we paid 300 naira as tax instead of 240. So now that's 60 naira. Is this temporary difference here? That simply means that we have a tax asset of 60 naira, which will be used to reduce our tax for the next period. So that is why in this case, payable, when the carrying amount of a liability is higher than the tax base, it is a deferred tax asset. Please, you can write it down somewhere in your notes. It's a very crucial point, because I had said that. So that simply means that our rule will have an adjustment. When the carrying amount of an asset is lower than the tax base, it is a deferred tax asset. When the carrying amount of an asset is higher than the tax base, it is a deferred tax liability. Same thing applies when the carrying amount of a liability is higher than the tax base, then it is a deferred tax asset. And when the carrying amount of a liability, emphasis on liability, is lower than the tax base, then it is a deferred tax liability. Okay, let's proceed. So how do we account for deferred tax? We have 3 steps. Step 1, identify the temporary difference. This is what we've done already, what we have been doing so far. Number 2, you multiply the temporary differences by the appropriate tax rate, which is what we've done already. And then you compare the figure to the opening figure and complete the double entry. Okay, this is where we will do something different. Okay, please, can someone read the question for us? Read this. Okay, take some seconds and go through the question, and then afterwards, please, someone should read the question for us. Thank you very much. Okay, please, can someone read the question for us?
Okay, accounting for deferred tax. Can you hear me?
Okay, I can hear you.
XPLC has non-current assets with a carrying value of 200,000 naira and a tax base of 140,000 naira. It has recognized a receivable of 10,000 naira. This relates to income which is taxed on a cash basis. It has also accrued for an expense in the amount of 20,000 naira. Tax relief is only given on this expense when it is paid. At the start of the year, XPLC had a deferred tax liability of 12,000 naira required. Show the movement on the deferred tax account and construct the journal to record this movement.
Okay. So we have a format here. Different tax balance at the start of the year. Then the transfer to the income statement, which is a balancing figure, and then the different tax balance at the end of the year. So balancing figure simply means deferred tax balance at the end of the year minus deferred tax balance at the beginning of the year. We will now have what will now take to the statement of profit or loss account. Okay. So like this said, step 1 is to prepare the tables to show temporary difference. Then step 2, you compute the tax rate. Then Step 3, you compare the figure to the opening figure and complete the double entry. So we'll do this. This is our working. Non-current assets is 200,000. Tax base is 140. So like the rule I gave, current amount is more than tax base. So it is automatically a deferred tax liability. Okay, so temporary difference is 60,000 and 30% of 60,000 gives us 18,000 is a liability. Same thing for income. We don't need any tax based for income because income is income. Income is how much you've gotten. Okay, so the tax authority do not have to compute any new income for you. So you still have the same liability of 3,000, which is 30% of 10,000 naira. Then the accrued expense is 20,000. Like I said, expenses are usually deferred tax. That's if current amount is higher than tax base. So here tax base is 0. So current amount is definitely higher than it's an asset. So we have 18,000 plus 3,000 minus 6,000. Because our deferred tax liability, we have 15,000 naira. So our deferred tax balance at the beginning of the year is 12,000 naira. It's in our question. At the start of year X, at the start of the year, XPLC had a deferred tax liability of 12,000 naira. So we have it there. And then our deferred tax balance at the end of the year, which is what we just finished solving, is 15,000. So 15 minus 12,000 gives us 3,000. So in our journal, in our income statement, our tax expense is 3,000. Deferred tax liability is 3,000. So that is the journal entry proper. It simply means that at the beginning of the year, we had 12,000 naira as taxation. And at the end of the year, our deferred tax balance has increased to 15,000. So what caused the increase? That is an additional 3,000 naira that has been added as a deferred tax. Okay. So we proceed. So what causes these temporary differences? What causes temporary differences? We could have issues, we could have situations when income or expense is included in the accounting profit in one period and included in the taxable profit in a different period. We also have issues of revaluation of assets where tax authorities do not amend the tax base when asset is revalued. When an asset has been revalued, we are supposed to change, when, like we did in IS 16, when an asset is revalued, it replaces the carrying amount of the asset, that's the next book value of the asset in the book. Sometimes the tax authorities do not remember to change their tax base to reflect the revalued amount of the asset. So this can cause temporary differences. And another one is when accounting depreciation does not equal capital allowances. Like we've seen already, in some cases, they will not be the same figure. Okay, so let's look at an example that leads to recognition of deferred tax liability. APLC recognizes interest receivable of 600,000 in its financial statement. No cash has been received and interest is taxed on a cash basis. So the interest receivable has a tax base of nil. Okay, so since cash has not yet been received, okay, it simply means that they are owing us a tax of 180,000 on that cash that's yet to be received. Okay, so interest receivable simply means that you are actually going to receive this interest. It's an income that is coming into your hands. Okay, so remember, every income is subject to tax. Okay, so that is why some persons were actually complaining, why would you make an investment in a company and when you receive dividend, even dividend is still subject to tax. Okay, so Same thing with interest here, the interest receivable, not the one you are paying. The one you are paying is not subject to tax, but the one you are receiving is an income, is subject to tax. So it's 600,000. The money has not yet been received. So it simply means that you are owing, as in this is a deferred tax liability. Whenever the money you receive the money, you have to pay us a tax of 180,000 naira. Okay, I have another one. This one is on development cost. Development cost may be capitalized and amortized in accordance with IAS 38, which is intangible assets, but tax relief may be given for the development costs as they are paid. Okay, so we have in the year ended 30th June 2014, BPLC incurred development cost of 320,000. These were capitalized in accordance with IAS 38 with an amortization charge of 15,000 naira in 2014. So development costs are an allowable expense for tax purposes in the period in which they are paid. They are allowable expense in the period in which they are paid. The relevant tax rate is 30%. Okay, let me give us some seconds. I should have given us some seconds first before reading the question. Let me give us some seconds before I start the solution. Okay, so here, development cost is actually in accordance with IAS 38, that is intangible assets. And we haven't treated intangible assets yet. So because intangible assets has its own criteria for recognizing a particular asset, a particular intangible asset as an asset, the recognition criteria, measurement basis, presentation, and disclosure. So here, based on what we've been doing, we've been told here that the amortization charge was capitalized. So when something has been capitalized, you do not compute tax on it. It simply means, capitalized simply means that that expenses has been added to the cost of the asset. So if it has been added to the cost of the asset, then we will not compute tax on it. So we deduct it from 320, and then we'll have 305, and then 30% on 305 gives us 91,500. Okay, please give us some seconds, and then someone will read the question for us. Okay, please can someone read the question for us? Please, somebody should read the question for us.
CPLC has non-current assets at 31st December 2013 with a cost of 5 million naira. Accumulated depreciation for accounting purpose is 2,250,000 to give a carry amount of 2,750,000. Tax deductible depreciation of 3 million naira has been deducted to date. The fixed assets have a tax base of 2 million naira.
Okay, so like we said, depreciation, they said here that accounting depreciation is not deductible for tax purposes in most tax regimes. Instead, the government allow a deduction on statutory grounds. Now, the reason why you have this carrying amount is 2,750 is because they said the carrying amount. That means this depreciation has already been taken care of in previous period. Okay, now somebody has not asked me why I said when the carrying amount. Okay, maybe I must have explained, but I need to add more points. Why carrying amount? If carrying amount is higher than tax base, why the difference should be taxed? Now the tax base is 2 million here in this case, and the carrying amount is 2.750. Now the reason why the tax authority asked you to pay additional tax on the 750 is because carrying amount simply means the value of the assets in the book. Now it is believed that this is how much this asset is worth, and if you are to sell it, you'll be able to 15 million on 2 million, and then there. So down the 750 to be, you will not pay tax on it, which is going to be an income for you in the future. So that is why this is a future income. You're expected to still pay tax. That is why it's a deferred tax liability. So in this case, it's still what we have been doing. The temporary difference of 750, 30% on it gives us 225,000 naira. Then we have warranty. Please, can someone read this particular question for us?
Okay. DPLC recognizes the liability of 100,000 naira for accrued product warranty cost. For tax purposes, the product warranty cost will not be deductible until the entity pays any warranty claims. Therefore, the tax base is low. The company is very profitable and does not expect this to change. This means that they expect to pay tax in the future, so should be able to recover the deferred tax assets.
Okay, thank you very much. It said that DPLC recognized a liability of 100,000 for accrued product warranty cost. Please, what's definition of warranty? What is warranty? When we get the word warranty, what comes into our minds?
Like an assurance.
What comes into our mind when we hear the word warranty?
Yeah, assurance.
What's a warranty? Warranty. Any idea? Okay.
Hello.
Okay, yes,
Yeah,
yes.
I said assurance. To give an assurance.
Okay, assurance. Okay. All right. I remember some years I went to buy a cell phone, and I was asking people what are the things I should look out for if I want to buy a cell phone. They said, buy this one. This one has a warranty. Buy the other one has a warranty. This one has 12 months warranty. The other one has 24 months warranty. Okay, what this simply means is that if this phone gets spoiled, instead of me to take it somewhere else and pay money for repairs, I could just take it back to where I bought it, to the manufacturer, and then they'll fix it and return the phone back to me. So now the cost of fixing the phone has been paid for me already by the company. So I don't need to, pay for it. Now, in this case, warranty simply means it is a cost. Money is going to go out of your hands. Okay, that's when people come to claim warranty. So it is a cost. That means it is a liability. So if it's a liability, like I remember I said, when the current amount of a liability is higher than the tax base, then it is a deferred tax asset. So you can see here the 30% on it is a deferred tax asset. Now the warranty has not yet been paid yet. Nobody has come to claim the warranty for now. So it's a deferred tax asset. That is why it is in the future. Okay, that's why it's in the future. It has so it's possible to have a temporary difference even if there's no asset or liability. So in such cases, there is a zero value for the asset or liability. For example, research costs may be expensed as incurred in accordance with IA 8, but tax relief may be given for the cost on a later date. Okay, example, in the year ended 31st December 2013, such cost of 500,000 naira. These were expense accordance with IAS 38. IAS 38 says that development costs and research costs should be expensed. So these were expense in accordance with IAS 38. Research costs are not permitted as a taxable deduction until a later period. So the relevant tax rate is 30%. Of course, research costs do not have carrying amount because it's an expense. So the tax base is 500,000, temporary difference 500,000, and then deferred tax asset here is 30%. So it said the research costs are not permitted as a taxable deduction until a later period. So right now, as it is an asset until we get to that later period. Okay, let's look at, we are in section 4, recognition and measurement rules. Look at recognition of deferred tax liabilities, how to recognize deferred tax assets, a recognition issue, that's non-taxable items, and then measurement of deferred tax balances. So it's possible that we have a deferred tax liability that arose from initial recognition of goodwill or initial recognition of an asset or liability in a transaction. Okay. So the initial recognition of an asset or liability in a transaction, which is not a business combination, and at the same time, and at the time of the transaction, affects neither accounting profit nor taxable profit. So we have some exemptions that has to do with goodwill. We've been doing a group account, which is part of FR and CR. So please, what is goodwill? What is goodwill? Please, can someone give me a definition of what goodwill? What do you think when you hear the word goodwill? What comes into your mind? Anybody? Please just speak out. No need to use the chat box. What's the definition of goodwill? Okay, so goodwill is not subject to tax. That's initial recognition of goodwill. So we have an example here. In the year ended 31st December 2013, APLC acquired 80% of another company and recognized goodwill of 100,000 in respect of this acquisition. The relevant tax rate is 30%. So goodwill carrying amount is 100,000. The tax is nil, and the temporary difference is 100,000. So there is no tax. Tax will not be computed because goodwill did not arise as a result of, it is a goodwill is an intangible asset. Same thing here. So even if a goodwill has a tax base, like here we have BPLC acquired a partnership and recognized goodwill of 100,000. In respect of this acquisition, the relevant tax rate is 30%. You will still not recognize deferred tax on initial recognition. Okay, we have another example here. This one is on loan. Now, if the transaction is not a business combination and affects either accounting profit or taxable profit, the exception does not apply and deferred tax is recognized on initial recognition. Okay, so in the year ended at December 2013, CPLC lent 100,000 to another company and incurred cost of 5,000 naira in arranging the loan. The loan is recognized as 105,000 in the accounts. Under the tax rules in CPLC's jurisdiction, the cost of arranging the loan is deductible in the period in which the loan is made. So that means that the tax authorities are going to recognize that we're going to deduct the 5,000. Meanwhile, in the account, it is 105,000. So current amount, tax base, the difference is 5,000, and the deferred tax on initial recognition is 1,500. Okay. Recognition issue. Non-taxable items. Okay, so a deferred tax should be recognized only in respect of those items where expense or income is recognized in both accounting profit and taxable profit, but in different periods. It should be recognized. Unfortunately, applying the definition of temporary difference given above would result in the inclusion of items where the difference might not be temporary or permanent in nature. Okay, like I said, we have permanent difference and we have temporary difference. I have an example here. EPLC has recognized 100,000 income as a receivable in its accounting profits for the year. This income is not taxable. So applying the definition of temporary difference would lead to the following. Receivable is 100,000, tax base is nil, and the temporary difference is 100,000. Now, we have said that this income is not taxable. So this difference is not a temporary difference. It's a permanent difference because it is not a transaction recognized in accounting profits in one period and taxable profits in another. Okay, we've been told that this income is not taxable. So it's a permanent difference. Permanent difference simply means that nothing you don't pay, the tax is not payable in subsequent period, neither is it deductible. Okay, so how do we measure deferred tax balances? Deferred tax assets and liabilities must not be discounted. Okay, we don't doesn't have this, you don't discount it. And deferred tax assets and liabilities must be measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled, which is based on tax rate, that's tax laws that have been enacted or substantively enacted by the end of the reporting period. So deferred tax and assets and liabilities must be measured at the tax rate that applies to that particular period. So business combinations, deferred tax as regards business combinations have revaluation of assets and liabilities in the fair value exercise, unremitted return, unremitted earnings of group companies, unrealized profit adjustment, and change in recoverability of parent deferred assets due to an acquisition. This part, business combination, this section is only for corporate reporting students.
May I ask a question, ma'am?
Okay.
Please, this slide, any way can be made available for us in any way?
The slides.
Yeah, this teaching now, since we are not having opportunity to copy some of these things down.
Yes, it will be sent to the group chat. Sorry
Okay.
if I said this earlier, it would have been sent much earlier.
So, thank you
You're welcome.
very much.
Okay. So, business combination. Please, can someone tell me what business combination is all about? What's just what you think when you hear the word business combination, what comes into your mind? Okay, we've been doing group accounts, which is still part of the syllabus for financial reporting and corporate reporting. And we talked about acquisition of companies, and that's what bring about we also have group companies, parent companies, subsidiaries, and the rest. So when a parent company makes an acquisition, it must perform a fair value exercise on the assets and liabilities of the entity it has acquired. Of course, this will result in a change in the carrying value of some of the assets and liabilities. However, the tax base will not be affected as it is based on the original cost. So temporary differences will arise for all revalued assets and liabilities. Remember that I said that as one of the sources of temporary difference is when the asset has been revalued and the tax authority has not reflected this revaluation in the tax base. Okay. So we have an example here. P Limited acquires 100% subsidiary on 31st December 2006 for 600,000 naira. The subsidiary's deferred taxation position at the date of acquisition was as follows. All figures. PPE, accounts receivables inventory, pension liability, accounts payable, temporary differences is 30. That's the difference between PPE. And then the deferred tax is 30%, which is 9. So PIT Limited carries out a fair value exercise. The deferred tax balance must be recomputed to take account of the fair value differences as follows. Okay. This is the parent company had now carried out a fair value, a revaluation, and then these are the fair value figures for those assets and liability. So PPE, the fair value is 270, tax base is 150. So the temporary difference is 120. Account receivable remains the same. Inventory, the fair value is 174, and the tax base is 124. The temporary difference is 50. Pension liability is 30, and the temporary difference is 30, negative. Okay, then accounts payable is 120,000. Tax base is the same, so we don't have any temporary difference for it. So fair value of net assets is 504. Temporary difference is 140. So the deferred tax will be at 30%, which is 42,000 naira. So in this case now, with this revaluation, we could see that the deferred tax has changed from 9,000 to 42,000. You know, previously it was 9,000. But when we had the revaluation, remember that in valuation, the tax base is still the same with what it was before the revaluation, before the fair value. So the deferred tax balance of 9,000 has to change. It has to be increased to 42,000. So when we are calculating goodwill, it's going to change. Our goodwill will be 600. As cost of investment will be 600,000. Fair value of net assets acquired. Remember, in computation of goodwill in group account, cost of investment, then fair value of net assets acquired as in the statement of financial position, we were given 504. So minus 42, that's the deferred tax. We have 462. So deducting 462, we have goodwill on acquisition as 138. So this is how goodwill affects deferred taxes. Okay, so it's possible that we could have unremitted earnings of group companies. Unremitted simply means that there are some profits that were and some earnings that were not remitted to those that are supposed to be remitted to. So this actually happens when a company acquires a subsidiary or an associate. So it acquires a right to receive dividend out of its accumulated profit. So temporary difference will arise on the profits of the subsidiary or associate that have not been distributed to the parent as at the date of consolidation. So for clarity, this is a parent's share of the subsidiary's post-acquisition return profit. So IAS 12 requires that a deferred tax liability should be recognized for those undistributed earnings because they will attract tax when dividends are paid to the parent in the future. So when dividends are paid, like I said, dividends are subject to tax. So when dividends are being paid in the future, they will also be taxed. So right now, ISOS requires that deferred tax liability should be recognized on those unremitted and undistributed earnings of the group company. Now, deferred tax is not recognized on such amounts if the parent is able to control the timing of the reversal of the temporary difference. We have unrealized profit adjustment. Like in the group company, we know what we have unrealized profits. This is when there's an intercompany transaction. Okay, when one company buys from the other and has not yet sold. Okay, so an adjustment is made because profit has not yet been realized because the goods has not yet been sold outside of the group. So, however, remember that tax has been charged on the profits of individual companies. It's not usually on the group as a whole. So the profit on intergroup sales will therefore be subjected to tax, and this will create a temporary difference. So the issue to resolve is whose tax rate should be used when providing for the deferred tax on this temporary difference. Should it be the seller's tax rate, or should it be the buyer's tax rate? So IS2 requires that the deferred tax should be provided at the buyer's rate of tax. So when computing the deferred tax, you should make use of the buyer's tax rate. Okay, we'll go back to presentation and disclosure. And disclosure. Okay. In presentation, like I said, every standard has sections for presentation and disclosure. How do you present the standards and how you disclose it? So in offsets of current tax and liabilities, when you offset current tax liabilities and assets, you offset it if and only if it has the legal enforceable right to set off the recognized amount, and it is intention either to settle on a net basis or to realize the assets and settle the liabilities simultaneously. You can also offset deferred tax liabilities and assets. You can offset deferred tax asset and liabilities if and only if the entity has a legal enforceable right to set off current tax assets against current tax liabilities, and the deferred tax assets and the deferred tax liabilities relates to income taxes levied by the same taxation authority. Okay. So disclosure, what and what are you expected to disclose as a result of this standard? We disclose any adjustment recognized in the period, disclose current tax expense, that's the income of the current tax. You disclose any adjustment that we recognize in the period, disclose the amount of deferred tax expense that relates to the origination and reversal of temporary difference, disclose the amount of deferred tax expense that relates to changes in tax rates or the imposition of new taxes. We also disclose the amount of the benefits arising from a previously unrecognized tax loss, disclose tax credit or temporary difference, disclose deferred tax expense arising from the write-down or reversal of a previous write-down of a deferred tax asset, disclose the amount of tax expense that relates to those changes in accounting policies and errors. So we have an example of offset of deferred tax liabilities and assets. It's simply to show how something that we've been discussing already. So if you have a deferred tax liability and you have a deferred tax asset, you use your asset to reduce your liability. So in this case, situation one, the tax liability was 12,000 and the deferred tax assets 8,000. So our tax liability will be reduced to 4,000. And for situation two, the tax liability was 5,000 and the deferred tax assets is 8,000. So we now have it as the result end as 3,000. Simply means that they have tax assets of 3,000 naira. So have a deferred tax asset of 3,000 naira, which will be used, which will be recovered in the future. So this is how in the statements of comprehensive income, we have current tax 429,000, adjustment for over estimate of tax in prior year 5,000. So deferred tax, the one that arose during the period 20,000. So when there's a change due to change in tax rates, we now have it reduced by 5,000, which gives us 15,000. So the tax expense is 129 minus 5,000 plus 15,000 gives us 139,000. It's possible that we could have a change in rate, that is the tax rate could change. Please, this section of presentation and disclosure is for both financial reporting students and corporate reporting students. So it's possible that we could have a change in taxation rates. At 31st December 2013, profits were taxed at 30%. APLC recognized a deferred tax liability of 30,000. It had a temporary difference of 100,000. So the tax rate changed to 25% during the year. At the end of the year, APLC carried out the following deferred tax calculation. So we have 1,820,000. Temporary difference is 180,000. So deferred tax at 25% will give us 45,000. Okay, so the movement of the deferred tax liability will be shown as follows. Deferred tax brought forward, that's when the tax rate was still 30%, 30,000 naira. Statement of comprehensive income. The rate of change, remember it has changed by 5%. That's been reduced by 5%. So we have 5 all over 30 times 30,000. So which is 5,000. So the deferred taxation brought forward restated is 25,000. Okay, and that is simply you can say 25,000 of 100,000 because we were told that this deferred tax liability was a temporary difference of 100,000. So just doing 25% of 100,000 will give us 25,000. And then statements of comprehensive income, the balance, okay, this should be a balancing figure. And then the deferred tax balance at the end of the year, what we just did, 45,000. So we now have a balancing figure of 20,000, which is what we'll take to our income statement as our tax expense and deferred liability. So what is tax reconciliation? Tax reconciliation, like we said, the tax between computed by the company is different from that computed by the organization, by the tax authorities. So we'll have to do what we call a tax reconciliation. So in the tax reconciliation, the following must be disclosed. There should be an explanation of the relationship between the tax expense as income and the accounting profit in either or both of the following forms. As there should be a numerical reconciliation between tax expense as income and the product of accounting profit that's multiplied by the applicable tax rate and everything. So there should be a numerical reconciliation between average effective tax rate and the applicable tax rate. Should also be an explanation of changes in the applicable tax rates compared to the previous accounting period. Okay, we have an example here on tax reconciliations. Okay. So BPLC had an accounting profit before tax of 500,000. This contained income of 20,000, which is not taxable. Accounting depreciation in the year was 100,000 and tax allowable depreciation was 150,000. This means that a temporary difference of 50,000 originated in the year. So BPLC's taxation computation will be as follows. Remember, the first thing is accounting profit, which is profit before tax. We add back inadmissible deductions. We have depreciation here, which was 100,000, added back. Then we deduct admissible deduction, that's allowable deductions. We had an income that is not supposed to be taxed. 20,000 is not taxable, so we deduct it so that it doesn't suffer tax. We have 180,000. Then we have tax allowable depreciation of 150,000. Then taxable profit is 430,000 naira. So computing tax will be 30% of that. We have 129,000. So current tax is 129,000 plus deferred tax, which is 30% of 50,000. You had a temporary difference of 50,000 initially. So adding that, we have a tax expense of 144,000 naira. Okay, so tax reconciliation in absolute numbers, accounting profits is 500,000. Applicable tax rate is 30%, which gives us 150,000. So the tax effect of untaxed income, that is, remember the income I said is not subject to tax, that's 20%, is 6,000. So we deduct it. We have a tax expense of 144,000. So we have tax reconciliation in percentages, 30%, which was the applicable tax rate. Then we have tax effect of untaxed income. The effect is 66,000 all over 500,000, which gives us 1.2%. So deducting it, we have an effective tax rate of 28.8%. That's 144,000 divided by 500,000. Okay. We've come to the end of the class. Please, do you have any further questions as regards this standard? Something you'd like me to explain again? Any further question? Okay, come to the end of today's class on IS 12. Please, do we have any questions as regards what we've done so far today?
Yeah. Hello.
Yes, I can hear you.
Hello. Yeah.
Yes, I can hear you.
Yeah. Okay. Yeah. Thank
Mm.
you. For the loan aspects, I didn't really get that point. Probably is it intercompany loan or something like that?
Intercompany
Loan.
loan.
Yes,
Is
you
it
talked about
under business combination?
yeah, under business combination.
Like, you mean intercompany?
Hello?
Yes, I can hear you.
Yeah, I'm talking about the intercompany under the business combination.
Okay. Okay,
Yeah,
we
I
have the,
didn't get.
okay, you didn't get which aspect of the business combination, the entire aspect of business combination.
No, I'm talking about the loan aspect also.
Loan. Okay.
The particular side.
Intercompany trading. Where we have unrealized profits. Is it the one?
No,
Intercompany loan under
not.
business.
Is it? Yeah, there's a particular aspect mentioned there. Loan. I think I'm under business combination also.
Okay, let me check. Okay, loan. Okay.
Yes.
It wasn't intercompany. Okay, let me go back to my slides. Coming. Okay, is it this one?
Yes.
Hello, sir.
Yeah. Hello.
Yes, I did this one. You're not sure.
No, I'm not sure.
Was it a calculation?
Yeah, I think yeah. It's not this one, but you can just.
Okay, maybe when you go through the slide, when you finally.
Probably when I go through the probably next class, I will.
Or you can still, when you go to the slide, you just check the number of the slide. If it's like slide 50 or 52, you could just mention it in the group chat, and then I will give a question that will explain.
Okay, no problem. Thank you.
Okay, sir. Okay, please, do you have any other question from any other person? Any other question? Okay, in the absence of any further question, we'll come to the end of today's class on IS 12.
Thank you.
Okay, thank you very much.
Thank you very much for the grant.
Yes, sir.